All right, what's up, everybody? So today we're going to be going over two really deep value dividend stocks that have higher than normal starting yields. So if you're interested in any of that, stick around. Let's jump right into it. So first one is going to be Flowers Foods Incorporated. So they are in the consumer staples. So they're more of a defensive play, and they also own the world-renowned bread of Dave's Killer Bread. So they bought them several years back, and they are down an immense amount. As you can see here, just over the last year, they're down over 46.5%. If you look at them on a 5-year chart, they're down almost 52% from their high. So why, you may ask, have they gone down so much? Has their fundamentals eroded or changed? So we're going to look at that today. I would say no, though. I would say it's just there's a lot of pressure from inflation, and also consumers are feeling it as well at the grocery store. They're having to pick and choose. So eventually that'll lessen, as well as people will become more conscientious about what they're eating. So basically today, you're buying them at a forward P of a 10.3 with a starting dividend yield of a 9.06. And their payout ratio is just shy of 94%. So it's getting high. However, the forward P is actually looking a little better than that. The dividend growth has been just under 5%. So when you're getting over a 9% starting yield, that's not terrible by any means. Look at their 1 year is slower at a 3.4. The 5 year is higher. And like you said, over the long term, we can go back to 2015. We see that they paid out 56.5 cents, roughly, just a little more. And in 2025, so far, they paid out almost $1. So they've definitely grown. And if we look at the trend line to see their average dividend yield over the last 10 years, we can see that we're buying them at the highest they've ever been in the last 10 years. If we scroll out to the all-time, you see that we wouldn't be comparable to this unless we were looking back in the 90s and like 2000. So we'll exclude that outlier since it's so far away and go over the last 10 years, and we're buying them at a huge yield. So let's go into the financials tab and take a look and see kind of what the numbers look like. So in 2015, they had net income of 191 million with 3.8 billion in total revenue. Fast forward to the trailing 12 months, they had 5.1 billion and 219 million in revenue. So as you can see, net income has not grown at a fantastic rate. It's kind of a little lackluster, really, for what I'm looking for, generally speaking. However, it is positive. And as you can see, the trend line is gone up over time. So let's take a look and see kind of the gross profit. So the gross profit margin has increased since 2015. And these are all numbers in millions as well. And so as you can see here, we went from a 1.8 or 1,815 rather to 2,517. So we definitely have gone up a little bit on the gross profit, and you can see on the trend line there as well. We want to look at the net income. So the net income, what they're bringing in after expenses. So it was 189.2 back in 2015. It's 219.5 now, trailing 12 months. So it has gone up. So we want to also look at, operations and see their expenses. Those have trended up over time. So that's why we want to keep a look at all of that. Let's take a look at the balance sheet, though. So balance sheet here, we want to look at the shares outstanding. We want to see a company that has either maintained or lowered the amount of shares outstanding, ideally, unless it's a utility, and certain other companies. But generally speaking, that's a good sign if they've lowered shares outstanding, because then it's actually made more value for the shareholders. So as you can see here, shares outstanding was 213.4. And again, this is in, millions. And then we look over here, it's 211.4 now for the trailing 12 months. So that is actually a really good sign. Generally speaking, it's decreased a little bit. So over the course of the 10 years, essentially, the enterprise value has gone actually down in the recent trailing 12 months. Like I said, It's because of interest rates, and it's because of all the pressures on these consumer staples. So they're not alone in that. General Mills, Clorox Company, so many other ones that if you look at them and actually see, cash and money that they're taking in, it's sustainable. However, the market has just revalued them for now. Institutional ownership in flowers is actually right around 80 to 85% as well. So that's another good thing that we like to take a look at and see and make sure, because that's a good sign if the big institutions believe in them. Free cash flow. So this is a good metric here. So it was at 240. Now we're at 383.5 million. So that's a good sign. Free cash flow has grown at a good rate. That's what I like to see, to be able to outpace how much they're paying in dividends, which they've definitely done. So overall, that's a really good sign. I do not see that the dividend will be cut anytime soon. If we want to take a look at the forecast as well, kind of where they're laying there. This, by the way, is a $2.31 billion market cap company. And the long-term projection, 2030, forecasts them reaching around $19.16. So with 2026 projections around 16.12. So if you're buying them today, just over $10 a share, just under 11, and it goes up to 16, you're already at a pretty good margin of safety there, since you're buying them at such a low price, and the chance for them to actually go up to a substantially higher price when you look at it for dollars to dollars is a pretty good chance. And you're collecting a much higher than the market average dividend yield of a 9.06. So just alone in the dividend yield, you're getting almost market return. And then add in a little bit of growth, and you're probably going to, like I said, outperform in the midterm. So this is a good one to consider for a defensive play. So it's not going to be some crazy NVIDIA returner, but with that high dividend yield and the price you're buying them today, there's a good sign that, as we recover and eventually one day get back to that $30 a share, it'll be a nice little handsome return for sure. All right, next stock, I kind of already alluded to it, but it's going to be General Mills. So General Mills is unique. They have a widespread number of brands. Flowers had it in all the bread brands, whereas General Mills has it in a lot of cereal, pet food. They all own many quality brands. So the list of brands is actually pretty astonishing and insane. So for example, GIS, General Mills. General. Oh my goodness, my spelling is off. Sorry, guys. There we go. Autocorrect has not been good to me. All right, so brands, here we go. So as you can see, this is just part of their portfolio here. So as you can see, they have Annie's, that's a more organic food. They got Betty Crocker, Autumn's Gold, Biscuit, Blue Buffalo. That's a real popular one. I know somebody that feeds their dog that. That's a healthier alternative. Cascadian Farm is also more of an organic one. Cheerios, Chex cereal, Epic bars with those meat buffalo bars. I mean, they own a lot of different things. The list of brands goes on and on, as you can see here. So a lot of really good quality companies, really. And yeah, I know junk food is a thing, and it's not going anywhere realistically. So, but they do have healthier alternatives, so it's not all just junk food. So right now you're buying them at a starting dividend yield of 5.1%. So their payout ratio is 58.33%, with the dividend growth of a 4.1% over the last 5 years. And then forward PE is not listed, but their current PE is about 8.7, so pretty reasonable, pretty cheap. If we look at them on a 5-year, they're down 18.33%. If we look at them on 1 year, they're down almost 25%. Let's take a look at the dividends over the long term. So you can see here on a 10-year chart, $1.73 they paid out in 2015. 2025 they paid out $2.42. So not a huge grower, however, just more of a steady Eddie consistency. If we go over their average trend line, go over the last 10 years for their dividend yield, we see that we're buying them at a high, with the exception to the end of 2018 when we were buying them almost comparable to this yield. So that's a good sign. We're buying them at a higher yield as well. Let's take a look at their financials. So financials, they had total revenue in 2016 of 17 billion with 1.7 billion in net income. Trailing 12 months, it's been 19 billion and 2.5 billion in net income. So it has gone up and trended up. However, it's been a slow climb. Their net income, as you can see, it has grown, which is a good sign. So we went from just under 1.7 to 2.536, and this is in millions again. So it has trended upward, which is a good sign. So let's look at the other part of the balance sheet. So go to their common shares outstanding. So as we can see here, they have bought back shares, not at a super aggressive rate, but they went from 611 million to now 542.5. So that is a good sign. They have bought back shares. And again, as you can see here, revolving theme enterprise value has gone up, and then it went back down in the last trailing 12 months and year or two. And that's just normal because, again, share prices went down, and also, the market is kind of revaluing a lot of more defensive plays, and tech is still heavy. So let's take a look and see their cash flow, their free cash flow. So as you can see, it has trended up, so it hasn't went down. So that's a good sign. And then a little more on their statistics here, which I don't think I covered here a little bit ago on the flowers, but payout ratio is maintained pretty steady Eddie in the low 60s to 50s, generally to 40s. So that's not bad at all. Right now we're in the 50s. So that's not alarming by any means. And revenue per share has gone up. Price to sales, you're buying them at a cheap price to sales compared to historical 1.38. Historical has been over 2. And then if we take a look, I like to look at the debt as well. So debt to equity and see how much debt they're carrying. So they're not carrying an extreme amount, 1.47 leveraged. We look at return on equity, return on assets, and return on capital invested. We can see they've been at a fairly decent margin, really, with that return on capital invested being in the low double digits to teens, with the return on equity being in the mid to high 20s to all the way up to 40%. So that's pretty good for an established business like this. And then return on assets as well has been in the high mid to single digits. So that's a good sign. I like to see all these numbers, and I do like what I'm seeing for the trend line. So General Mills is an interesting opportunity. If we take and zoom out here, their all-time high was about $90. So when was that? That was in 2023 of April. And since then, it's been a slow trend downward. So right now, I think that they still have further pressures ahead of them. However, in the long term, where do they see it? Where do analysts see it anyways? So let's see if they have even a price target. So let's look at AI. All right, so right now they have it as a hold consensus. So with a price target of about $53 to $53.50. However, that's still above the current price. And it offers that strong over 5% starting dividend yield, which is safety. So it's a good consumer offensive to play. And we look at here, the pet food division had 11% revenue growth. So like I said, General Mills is an interesting play long term. And I don't want to gouge you guys here. So let's look at the metrics real quick, back up again to flowers and show you the stats on the last page. So as you can see here, their price to earnings is the cheapest it's been over the last decade. The payout ratio is maintained fairly steady in that ratio, sometimes getting a little high, but steadying out. And then again, we want to look at return on capital employed as well as equity and assets. And we see it's a fairly healthy, sustainable yield here. And then debt to equity is not super duper high, very similar to General Mills, 1.46. So overall, I kind of like what I'm seeing with both of these companies. They're interesting long-term plays. They're have a decent to higher starting dividend yield just to begin with right out of the bat. And then you can get your yield on cost up over time. So these are definitely ones to consider. And if you guys have any other stocks or things that you want me to review and go over here on the channel, I can do that. Just drop me a comment down below. Let me know your thoughts. And I hope you guys have an awesome day and have a good Merry Christmas coming up. All right, take care.